Let's talk some earnings. We've got Netflix coming up. Joining us from Wedbush Security is Alicia Reese, is Vice President of Equity Research, covering the stock as well as other entertainment plays we're going to discuss here. Alicia, thanks for joining us. Netflix.
Thanks for having me, Oliver.
Absolutely. This is a pretty fun report because, Netflix is just killing it the past year. And it feels like their business model's gotten more reliable than ever these past few quarters. So should we be expecting less volatility on these reports nowadays?
Well, you certainly have a little bit of volatility expected because they're lapping the password sharing crackdown. The survey work that we've done in the quarter, though, does suggest that they are still benefiting from that. They're still cracking down on accounts. They hadn't run through every account. And they're still benefiting from the ad tier as more members who had churned out before come back and they choose the ad tier. Or if, they have never tried Netflix and they didn't like the pricing, they can come in at the ad tier as well.
Okay. And at this point, how much transparency do we have there on who's sticking around with that and what kind of metrics then drive the stock? What's kind of the most important metric then?
Yeah, so far, throughout Netflix's history, it's the subscriber numbers that matter the most. Increasingly, it's the ARM, the ad revenue, or sorry, the revenue per user, per member. And in 2025, they're going to stop giving those metrics. And so they want investors to focus solely on top line revenue and earnings. And the reason is because if you're just tracking the subscriber numbers, you're not seeing the huge benefit that they expect over time from that ad tier. And that's not just the membership, and it's also the viewership, how often they're on the platform watching those ads and how many advertisers are on there and how much advertisers are willing to pay for those ad spots. Right now, those CPMs are quite high. They started off astronomical. They've kind of come back down to earth, but I think they'll stay elevated over time as that viewership rises, and especially as Netflix adds live events and live sports, those CPMs are going to rise even further. The viewership's going to increase, and Netflix's revenue is going to show that handsomely. And it's a little decoupled from that subscriber numbers.
When do they start offering shareholders a little bonuses, dividends plus buybacks? Like, are we at that point of maturity for Netflix?
Well, they're certainly producing a lot of earnings and a lot of free cash flow. Between 2023 and 2026, consensus estimates that EPS will more than double. And that's getting into a pretty astronomical range for them. And, that puts PEG quite low. They can certainly do it. They still see themselves as a growth stock, and I think they're going to continue to operate as a growth stock as long as investors allow them to. Once they start getting that significant pushback, then we'll start seeing some dividends, I think. But I think they'll at least try to get through 2025 with the ad tier as their growth driver.
Okay. Seems like they're getting close, to being able to kind of almost operate like an entertainment utility in a way, given the stickiness and the reliability of their customers. I think what's fascinating, though, that a lot of people don't know, more likely, I think people know how dominant Netflix has gotten, but some of the other companies in your coverage have had really extraordinary performance over the past year. Cinemark is one. NCMI is another one, which is like an overlooked national cinemedia, which, as I understand, is the advertising component. So is that just because people are going to theaters that Cinemark's doing so well, or what's going on here?
Yeah, so for National CineMedia, the interesting story is that they had a horrible time, obviously, through the pandemic when theaters were closed or were underutilized. And then just as that was coming back, the ad market was faltering. And so they've just gotten hit from every side. And just as that was starting to come back, the SAG-AFTRA strikes hit theaters again. So they've had a rough go. But just about now, you're seeing the ad market start to come back. You're seeing theaters coming back in the fourth quarter and certainly throughout 2025. So that should benefit National CineMedia quite handsomely. They've just gone through an extremely long upfront season. And, we don't know how that's going to fall yet, but once they report the next quarter, I think we'll get a good idea.
Okay. And is this contingent on how well the big movies do, or is this now just kind of like a recovery trade that's got momentum now that we've kind of normalized entertainment?
I'd say both, Oliver, because you have one side where it's the upfronts where, you have to have a good recovering business for the advertisers to lock in those ad spots. And they have some of the highest CPMs in the industry because you have a really focused environment in a theater, especially after the movie start times. You have those premium spots where the lights are down.
Right.
All you see is this massive screen in front of you. So that ad spot is pretty valuable. What you also have is the scatter market. So if you're having, you see a really big movie out there that's just hitting really hard, especially Gen Z, those advertisers want to get involved. And so they're going to pay even higher CPMs in the scatter market. So you want to see both throughout the year, honestly.
Wow, fascinating. All right. Well, they might be missing me because I always show up after all the stuff. I'm just getting there right when the main event begins. Great stuff, Alicia. Thanks a lot.